Welcome everybody to today's taxes and retirement presentation. Specifically today, what we're going to be talking about is taxes and retirement after the Tax Cuts and Jobs Act of 2017 went into effect. I am today's presenter. My name is Casey Johansson. I am one of 5 financial advisors that we have here at Hammer Financial Group. And then just to touch on the agenda, some of the main points that we're going to get through today. First and foremost, we want to understand the legislation and what changed, what stayed the same. We definitely want to understand what marginal tax is if you don't already know. We want to be able to understand the different interactions between different income types that you may have while you're in retirement. And then probably the biggest reason why most of you guys are attending today is for the strategies to reduce your lifetime taxes. And then finally, we'll talk about next steps and how to get started in implementing some of those strategies. So first, just to understand kind of where we're at in the tax code, most people have seen the standard tax table. Now, there's 2 types of tax rates we're going to talk about today. There's ordinary income tax rate, which is what you see on your screen here. And then there's the capital gains tax rate, which differs a little bit. It's more preferentially taxed, which we'll get into in the next slide. But most people have probably seen these ordinary income tax brackets. You see it ranges from the 10% all the way up to the 37% for very high income earners. What we see and what's actually changed with the Tax Cuts and Jobs Act of 2017 is a number of things. Actually, we've seen two major things change. One, the actual tax rates themselves went down. So the actual percentages you see, where it goes from 10 to 12 to 22. Well, the 10% stays the same, but under the old tax code, the 12% was actually a 15% tax implication. The 22 was actually a 25% tax implication, and the 24 was a 28. And then, the other rates have changed as well. But the other main part that changed is not only the rates went down, but the actual brackets themselves got a lot bigger. So now we see under this new tax code, you have over $340,000 worth of joint income on your tax return before you ever surpass a 24% tax implication. Under the old law, you would exceed a 25% tax implication with anything over $77,000 of income. So there's a number of things that provides us, a lot of planning opportunities that provides us with. And you see the 2 big jumps here. So this is what we call our ordinary income tax roadmap. So this is just a different way of looking at those tax brackets. You see the 2 biggest jumps are actually our 2 biggest planning opportunities. You see where we jump from the 12 to the 22. That's a pretty big leap, right? A 10% increase in that tax bracket. And then again, from the 24% jumps all the way up to the 32% bracket. Those 2 points are where we focus mainly on when we look at tax planning, because it provides a lot of tax planning opportunities for us under the new tax code, which we'll get into in a little bit here. Now, I mentioned the second tax rates that we're going to talk about today is the capital gains tax rate. Okay, and it has its own separate tax bracket for capital gains. So what is a capital gain? Well, capital gain, you can experience capital gains tax on a number of different types of investments. But the key is that the type of investment would not be in any kind of tax deferred retirement account. So for example, if you just had a brokerage account, held, it could be at any of the main custodians, Fidelity, E-Trade, TD Ameritrade. If you had a individual stock, a security in that account, and it's not held in an IRA or a Roth IRA, and you bought that individual stock and now it's appreciated. Let's say, for example, you bought $10,000 worth of Apple stock, and now all of a sudden it's worth $100,000. Well, that gain, that internal gain that you have for buying at 10,000, now it's worth 100. You have $90,000 of capital gains embedded in there. When you go and you sell that individual stock, now all of a sudden those are capital gains income, and it's going to get taxed at the capital gains tax bracket, which is completely different from that ordinary income tax bracket. You actually see you have a 0% capital gains tax if your income as a married filing joint couple is under $83,350 worth of income. Now, once you cross over that threshold, now you jump up to a 15% tax implication, which, if you notice, looking at comparing the capital gains brackets with the ordinary income tax bracket, the 15% capital gains actually falls into that 22% ordinary income tax bracket. So when I say capital gains tax brackets are preferentially taxed, I mean you're paying a smaller percent of tax on those capital gains as opposed to ordinary income. Okay, and ordinary income is going to be things like your wages from your job, IRA distributions or 401k distributions, any pensions that you have, interest income, things of that nature. Whereas capital gains is strictly going to be if you sell a security that has appreciated in value and it's not held in a tax deferred retirement account somewhere, then you're going to be exposed to this capital gains tax rate. And there's some complexities that actually happen with capital gains, which we're going to get into further on in the presentation here. But really the main sticking point is what we want to relay to you is that capital gains are actually a preferentially taxed tax implication, right? Where you're going from a 0% to a 15%. And then the maximum rate you'll ever pay with capital gains under the current code is 20%. And you don't experience that until over $500,000 in taxable income. Now, if we just had to worry about those two, ordinary income tax brackets and capital gains tax brackets, the tax code would be pretty intuitive, right? We could figure that out. We can figure out what our tax implication would be if that's all we're dealing with. But when you go into retirement, and this is really where everything kind of culminates together, you have different things that happen to you when you're in retirement. When you're still working in what we would call the accumulation phase, you have just an income, usually just an income, maybe some capital gains, but wages is your primary source of income. So it's a lot more easy to calculate. You have a much simpler tax return typically. But then once you get in retirement, now a lot of different things go in and can affect that simple tax return. So the real tax system is things like required minimum distributions once you turn 72 in retirement. Capital gains, which we mentioned earlier, Social Security benefits and how those could potentially be taxable, Medicare premiums, and then even large withdrawals from IRAs or potential Roth conversions, large sums of income showing up on your tax return. So let's start with required minimum distributions. What are they and how do they work? RMD for short. Basically what happens is all of your pre-tax retirement accounts that you have, so things like 401ks, 403bs, IRAs, 457s, whatever it may be, if it's an employer-sponsored plan or an individual retirement account, the key is if it's a pre-tax account, well, then all of the money that you put into that pre-tax retirement account, you've never been taxed on. You've never paid taxes on any of those. So what happens is, of course, the IRS and the federal government, they want their tax revenue from those accounts that they've never seen a penny in taxes paid on. So what they deem the age that you should be retired at currently is the age 72. So what that means is at age 72, the government or the IRS is going to force you to start taking withdrawals from all of your pre-tax retirement accounts, whether you need to take the money to supplement your income or not. They don't give you a choice. If you don't want it, you don't get the luxury of not taking it. You're forced to take those distributions. And the way that they calculate it is they're going to take the tax year that you turn 72. So it could be January 1st, it could be December 31st, whatever calendar year that you turn 72, you're going to be forced to take your first distribution. And the way that they calculate it is they're going to look at the prior year's December 31st value. They're going to take that number and they're going to divide by the remaining life expectancy. Okay, so you see an example here. If you have $500,000 in a pre-tax retirement account and the age 72, basically what you have to do is you take the 500,000 and divide by that 27.4, which is your quote unquote life expectancy. And that's going to give you what your RMD is. Now, why do they make you take a number and divide by it? I don't know. They like to keep you on your toes. They like to keep you confused. What they should do is just give you a percentage, right? A percentage of that account every year. It would be a little bit easier to calculate. It ultimately does equate to a percentage, but it's a very exact percent. So the year that you turn 72, they force you to take just under 4% out in a withdrawal. But every year that you get older, your life expectancy shrinks, right? So that percentage is going to go up every year that you get older. They're still going to use the prior year's December 31st value, but the factor that you're dividing by keeps going down every year. And what that means is the outcome or the distribution that you're required to take is going to continue to go up. And here is what that table looks like. Again, at age 72, they make you divide by that 27.4. And you notice every year you get older, that number that you divide, that factor continues to go down. And what happens when you divide by a smaller number is the outcome increases. So that's one thing that we're going to talk about that can potentially impact your taxes while you're in retirement. Something that maybe you see coming, maybe you don't. The next thing is capital gains. Now, I already mentioned capital gains to you once, and the idea is the same, right? Normal capital gains, long-term capital gains. If you hold a stock, it could be property, it could be a number of different things. If you hold that for over a year and there's appreciation, you go and sell that, you're going to get hit with capital gains tax, potentially. But what a lot of people don't realize, if you have mutual funds in a non-retirement account, so like a brokerage account, you can have what's called mutual fund pass-through gains, or sometimes they're referred to as phantom gains. And essentially how that works is because you're invested in a mutual fund in an account that's not tax deferred, like an IRA or a Roth IRA, you're basically pooling your money with a number of different other investors, and you're having that mutual fund manager manage the account. And they're going to make trades internally in that mutual fund year in and year out. Some of those investors that you've pooled your money with inside of this mutual fund, sometimes they have to take their money out. And what happens if they need to take their money out? Well, the mutual fund manager has to make changes and sell investments inside of that portfolio to be able to get them their money. And when that happens, there's capital gains that are triggered inside of the mutual fund. And what happens with that is at the end of the year, they're going to calculate, okay, how much internal capital gains did we create in this calendar year? And they're going to pass those gains through onto all of the mutual fund investors' tax return. So even though you didn't actually sell your mutual fund or liquidate any investment, make any changes, you can potentially have capital gains land on your tax return with absolutely you doing nothing. Okay. And we've seen that a lot, specifically this last year in 2021 is one of the biggest years for long-term capital gains distributions inside of mutual funds. Okay. You could also accidentally get hit with capital gains if you have rebalancing triggers on your portfolio. Okay, that's another way that, or that's another thing that can actually happen internally that you may not have known about, but it creates a taxable event. And then what you really have to understand is long-term capital gains, although they're taxed preferentially, they can actually create ordinary income tax, okay, which we're going to talk about here in a second once we bring all of these different ideas together. So the next thing we want to talk about is Social Security, okay, and how that gets taxed, or does it get taxed? Some people might think it's not taxable. Other people think it is taxable. Well, which one is it? The answer is both people or both sides could potentially be right. Currently, if the only income that you have showing up on your tax return is Social Security, well, you're not going to pay any federal taxes on that Social Security benefit. As your income, as you have other income coming in on your tax return, and it could be wages, it could be IRA distributions, pensions, a number of different things, interest income, long-term capital gains. As you have other things land on your tax return as income, they're going to potentially move your Social Security from being non-taxable to now being taxable. Okay, and Social Security gets taxed at the ordinary income tax brackets. So you're paying the higher percentage on that Social Security income. Okay, now how they determine exactly how much of your Social Security benefit's going to be taxable is they use an equation. It's called provisional income. The first step in that equation is they're going to take 50% of your Social Security benefit, and they're going to add it to everything else that falls on your tax return as income. Okay, ordinary income, dividends and capital gains, even non-taxable interest. Now, currently, the only thing that doesn't show up for provisional income purposes is Roth IRA distributions and non-taxable life insurance payouts as well, distributions from that. So now once you calculate that provisional income, there's thresholds, and it's different for a single individual as it is for a married filing joint couple. We look at the married filing joint couple. We're going to focus on that today. Now, that doesn't mean that these things that we talk about for single individuals don't apply to you. In fact, they actually apply more to you because, as you can see, the thresholds are much lower for a single individual than they are for a married filing joint couple. So these different things that we're going to talk about, they're even more relevant for single individuals. But for today's purposes, we're going to focus on married filing joint. So if we look at that, it's the bottom chart, bottom graph, or the arrow, I should say. The first threshold is $32,000. Once you cross over that first threshold, that provisional income number, right? Once that surpasses 32,000, they're going to take 50 cents on the dollar for each dollar you're over. And they're going to take Social Security and shift it from being non-taxable to now being taxable. And then there's a second threshold of 44,000. Once you surpass that, now all of a sudden an additional 35 cents on the dollar for every dollar you're over that $44,000 threshold now becomes taxable as well. So that's very confusing. It's hard to kind of imagine what that actually looks like and how that number is calculated. So I want to show you an example of exactly how that works, okay, to kind of clear the air with that. So the first example, and both of these examples, we're going to show you two. Both of these examples have a married filing joint couple with a $60,000 income need for the year. So in other words, they need to have $60,000 in income, okay? In this first scenario, how they get that $60,000 is 20 of it is coming from Social Security and 40,000 is coming from an IRA withdrawal. So what's their provisional income? Remember the equation. They're going to take half of your Social Security benefit. So half of 20 would be 10. And then they're going to add it to everything else that falls on the tax return as income, including this $40,000 IRA withdrawal. So if we take the provisional income as 40,000 plus half of the Social Security, which is 10, their provisional income is 50 grand, which coincidentally is over both of those thresholds. It's over the first threshold, the 32,000, by $18,000. So they're going to take half of the amount that it's over. In other words, they're going to take 9,000. That's going to become taxable, but they're also over the second threshold. Second threshold is 44,000. So they're over that by $6,000. They're going to take an additional 35 cents on the dollar for how much they're over that threshold. It equates to 2,100. So you add those two up, their total taxable Social Security benefit is now $11,100, or 55% of their total benefit is taxable now at the ordinary income tax level. Now, the other example shows more income coming from Social Security. Now, they still have the same amount of income, 60,000. The only difference is now 40 of it's coming from Social Security, 20 of it has to come from an IRA withdrawal. So in this scenario, they're going to take, for the provisional income, they're going to take half of 40, which is 20, add it to the $20,000 IRA withdrawal. So their total provisional income is $40,000 in the second example. Well, $40,000 is over that $32,000 threshold by $8,000. You take 50 cents on the dollar of what that amount is over, and it equates to $4,000. In the second scenario, they're not over that second threshold at all. So the only Social Security benefit that's taxable for them is $4,000, or only 10% of their total benefit. So what does that look like on the actual tax return? Well, in the first scenario where they had to take more out from the IRA, their taxable Social Security was $11,100. Their other taxable income was that $40,000 IRA withdrawal. That leaves them with $51,100 in total taxable income. After you deduct all the standard deductions and the personal exemptions and all that, they're left with a net taxable income of $22,400, which equates to $2,240 in total taxes due. Okay. In the second scenario, remember, maybe they possibly delayed their Social Security benefit, maybe till full retirement age, maybe to 70. Either way, they have more Social Security benefits coming in, which means they had to take less out of their IRAs. And in that scenario, they only had $4,000 in taxable Social Security, only $20,000 from an IRA withdrawal. So their total taxable income is $24,000, which is completely eliminated or wiped out by their standard deduction and personal exemptions. So they actually have no net taxable income and a $0 federal income tax. So that's a difference of $2,200 or just over $2,200 in taxes, just by understanding, and again, they may have just delayed Social Security longer. The higher your Social Security benefit, the more tax efficient your income can potentially be. So there's a lot of reasons why you would want to look at delaying Social Security, more than just for tax purposes. But that is one strategy that you can look at implementing by delaying Social Security. It could potentially make all of your retirement income more tax efficient. Okay, the other thing that we want to make sure we touch on today is the Medicare excess premiums, or what most people know as the IRMA guidelines, income related monthly adjustment amount. Okay. Basically, Medicare Part B premiums are means tested, meaning the more income that you show on your tax return, the more they're going to charge you for your Part B and your Part D costs for Medicare. Okay. Part B is typically going to be taken out of your Social Security if you're collecting Social Security. Otherwise, they'll bill you. And Part D is your prescription drug plan cost. So you can see on the graph, if your income as a married filing joint couple is less than $182,000, you're going to pay the minimum $170 in your Part B premium, and whatever the cost of your prescription drug plan is. There's not going to be any additional cost for that. But then once you cross over that 182, it's going to accelerate really quick. There's 5 different brackets, okay? From 182 to 228, now all of a sudden your Part B premium per person goes up to $238, an additional $12.40 for your drug plan costs. Once you're over the 228, now it's all of a sudden 340, and it goes to 442, 544, and the highest currently is $578 per person for your Part B costs. Now, one thing that a lot of people don't realize is most people hear about Social Security being quote unquote broke, right? Or the system is broke. Well, Medicare is actually in a worse spot than Social Security is as far as funding is concerned. So what we feel is that there's a good chance that they're going to end up shrinking these IRMA brackets so that more and more people are going to be charged an excess premium on their Part B and Part D plans. Okay, so it's important that to understand that all of these different things come together to affect your budget and tax implication when you're in retirement. All right, so we went over all of the different things that can happen when you're in retirement. Now let's put them all together. So what we're going to talk about now is the effective marginal tax rate. How much of your last dollar do you actually lose to Uncle Sam? So we're going to show you an example. It's a case study. And John and Jane, they're a married filing joint couple, and they're over 65 years old. They have combined Social Security benefit of $61,000. They have $10,000 of net long-term capital gains, and they have required minimum distributions of $52,000. Okay. This is what their tax roadmap looks like. So if you notice here, there's a lot of gray on their tax roadmap. This tax roadmap, by the way, this is the software that we use to do our tax planning for our clients in conjunction with the tax practice that we have in our office for us to have access to these tax preparers individually, to be able to verify data. So this gray area, that's your effective marginal tax rate. Okay, that's the last dollar, or that's the percentage of the last dollar you lose to Uncle Sam. You see the shaded red area, that's the standard tax brackets. Okay, that's the ordinary income tax brackets. So you see just under $30,000 in that red area, that's the 10% bracket. Okay, then it jumps up to the 12, and then the 22, between 100 and 110,000 there. So you notice probably by now that the highest effective marginal tax rate is nearly 50% for this couple. This is John and Jane. How does that happen? How does that 50% marginal tax rate happen? Well, let's show you. Intuitively, if John and Jane took an extra $1,000 from an IRA withdrawal, remember they are in the 12% bracket. So conceptually, what should happen is they should owe $120. But what actually happens, they do owe $120 on that additional $1,000 that they took out. But that extra $1,000 caused $850 of their Social Security, which wasn't taxable, to now become taxable. And in the 12% bracket, that equates to $102. Now, because there's $1,850 more of income on the tax return, now that causes $1,850 of capital gains to now be taxable, which weren't before. So that's being taxed at the 15% bracket. Now all of a sudden you're owing an additional $277.50 in taxes on that. You combine that all up, and that's $499.50 of tax that you actually owe the federal government for taking $1,000 out of your traditional IRA, right? That's the gray area. That's the effective marginal tax rate. Okay, all these different things come together to really wreak havoc on your tax return, and you may not even know it. Now we're showing a pretty small example. What happens if we show a bigger example? That 50% effective marginal tax rate lasts for just over $10,000. So now instead of showing $1,000 in an additional IRA withdrawal, what if it was $10,000? Maybe you had to take out 10 grand to put a down payment on a car. Cars are really expensive these days. You don't want to finance it all. You want to take out 10 grand to use as a down payment. Well, guess what? You go talk to your tax preparer and ask them, how much should I withhold for taxes if I take out 10 grand? They're going to tell you you're in the 12% bracket. Withhold $1,200 or 1,000, yeah, with $1,200. When in actuality, you owe $5,000 in taxes to the federal government. So you're off by a lot. All of a sudden you're owing $3,800 on your tax return, and you're going back to your tax preparer. What happened? Well, that's the difference between tax preparation and tax planning. You have to be able to look forward to see some of these obstacles. And what we want to do is we want to be ahead of the curve. We want to be already having a plan for these types of situations, so that when they happen or when we are put in that situation, we know, well, maybe if we did Roth conversion planning a couple of years ago, we'd have the money in the Roth so that if we take it out from the Roth, none of this happens. So it's just the forward thinking when you're looking at tax planning that can save you a significant amount of taxes in your lifetime. And you'd be surprised how significant it actually is. So what are the different tools that you have? Well, there's a couple. I mentioned Roth IRA conversions. Right now, we're doing it for a lot of our financial clients, okay, because it makes sense to do it. We're in as low of a tax rate environment that we're probably going to be in for the rest of our lives. We want to take advantage of these tax rates now while they're low, while taxes are on sale. We want to separate ourselves from the IRS. We want to convert our pre-tax dollars into Roth dollars. And we pay the taxes on that now. But what that's going to do is it's going to eliminate a lot of these different things that I just showed you from happening. Potentially can eliminate you from ever having to pay excess premiums for your Medicare. It could help protect you against taxes going really high, which is probably going to happen one day. We know taxes are going to revert back to the higher amount in 2025. It was written into law for that. What we don't know is how much further they can go from there, and they probably will, because the nation, our country as a whole, is in a severe deficit, right? We're in a lot of debt, and there's only two ways to fix that debt. Either stop spending money, right? Or increase the amount of revenue that we have coming in as a country. And the best way to do that for them is by income taxes, okay, and raising those. So Roth conversions, undoubtedly, for most individuals, are going to be a very valuable tool. Now, I say most because it's not going to be valuable to everybody. It really depends on your specific situation. And that's why we're going to offer a strategy session for you guys to be able to take advantage of an actual conversation, complimentary, with one of our advisors, to be able to kind of just kick the tires, answer questions, get your questions answered, I should say, and just see if there's value in looking at doing these advanced tax planning strategies. The other thing that you can look at doing is just making sure while you're saving, you're diversifying among different account types. You can save in pre-tax accounts, but also save in tax-free, like Roth, or taxable accounts, which are, again, preferentially taxed with long-term capital gains and non-qualified accounts. Make sure you have those different assets available to you, because when you're in retirement, you get to choose where your income's coming from. It's not like when you're working and your boss, you're not going to tell your boss to pay you less so that you pay less taxes. You have a choice as to where your income comes from in retirement. So make sure you put yourself in the position to be able to take advantage of that. Okay. The third thing is properly blending your withdrawals from different accounts. If you've diversified among different account types, you can properly blend withdrawals from all three different types to make your income as tax efficient as possible. And then the fourth thing is more of an asset placement strategy as far as, okay, what accounts or what assets should be held in which account types. And the example that I give people is, okay, if I have a Roth IRA and a traditional IRA, the traditional IRA grows taxable, right? Every penny I take out is taxable. In a Roth IRA, it grows tax-free. Every penny I take out is completely tax-free. Which account do I want growing faster? If I have them both allocated the same, maybe I'm a balanced investor and I have each account is invested exactly the same, 50% in stocks, 50% in bonds. Well, they're growing at the same pace. Which one do I want growing faster? The Roth. So what you need to do is make sure you have the Roth tilted or leaning more towards a growth orientation, and your taxable, which is the pre-tax account, to be more conservative. You don't have to change your risk tolerance at all. Instead of making it 50-50, possibly make the Roth 100% equities, or at least some combination of a more growth orientation with it, because that's going to create a ton of value for you over time. And the asset placement strategy that we use, we actually use the bucket plan philosophy. Now, you guys, we offer the bucket plan book to you at no charge. Really what it's meant to do is eliminate some of the different risks that you have, not even the tax risk, right? But on over and above with that, things like sequence of returns risk. We want to attempt to minimize all of the different gaps in our income distribution plan for us in retirement. We want to have a plan in place for everything that could potentially go wrong. And the bucket plan really, really helps us to be able to do that for our clients. So again, I urge you to take advantage of the strategy session that we're going to offer here at the end of this presentation. And then we're also going to offer you a copy of the bucket plan book in addition to that, so you can get a better understanding of different philosophies that we use in our practice to help minimize risks for our clients. And our process is a 4-step process, okay? The first step, obviously, is to take advantage of the complimentary strategy session. It's a phone call, typically lasts about 20 minutes. It's meant to really answer any questions that you had from today's presentation, but also to get an idea of if the advanced tax planning would benefit you. But then our planning process, we'd use a 4-step process. Discover, we want to understand more about you, what assets you've been able to accumulate through your working years, what your goals, objectives, and priorities are, and just be able to gather enough information to be able to create an income plan for you. And then in that design stage, step 2 is really about showing you exactly what your plan looks like and how we can improve. What strategies really should you be considering implementing in your plan to create a better outcome or a more predictable outcome. And then deliver is your implementation of those recommendations, and the dedicated number 4 is the dedicated ongoing servicing that we provide as our financial client. Now, Hammer Financial Group is a holistic firm, so we do almost everything A to Z that you could potentially need when you're entering this retirement phase. We do the wealth management with the investments, obviously. We have the tax practice, which allows us to do the advanced tax planning for our financial clients. We have healthcare and Medicare agents in our office to walk you through that, because that can also get confusing. Social Security planning, we have the softwares capable to really figure out the optimal strategy on how to collect that. We also have an estate planning attorney out of our office, and then we also have insurance agents, long-term care, life insurance. It's an integral part of a holistic plan. Okay, I mentioned the bucket plan book. I urge you to take advantage of the introductory phone call. One of our staff will potentially reach out to you in the next day or so if you want to request the introductory phone call. They'll be able to get you set up in one of our calendars here. And don't forget to follow us on social media as well. Thanks for attending today. Really appreciate you guys taking time out to learn more about taxes. It can be a A confusing subject, but a very important one nonetheless. Thank you.